Thanks.
Guys, hey, good afternoon. Thank you for being with us. I want to use just a process that just actually works. I know that we all have talked about the national debt. Hopefully, that is a topic of discussion, unfortunately, that you have every day. But the real challenge is that not only is it 38 trillion and climbing, but there are unfunded liabilities of $107 trillion. If you don't understand the importance of that, there's more taxation to come, is the simple answer. A projected $84 trillion worth of wealth transfer from baby boomers to their heirs by 2048. Cerulli Associates, if you don't know who Cerulli Associates is, it's really important that you do. Most of us use this as a widely respected research and consulting firm for all of our investment advisors, carriers, and industry trends as we look into this data to make sure that we're building the right products and also designing the right solutions for you to present to your clients there. So they have given us that additional projection of 124 trillion in wealth transfer, and alongside some governmental changes and really some potential policy drivers that may reshape estate tax legislation, we've got a problem. And so today's simple way of communicating this at the table with your clients is really going to help you. I hope you will take some notes here. I think it'll be encouraging to use this in your daily practice because honestly, clients want simple. They do not want something that is difficult or complicated. And so many times we run into advisors, Bill and I both sit at the table with you and your clients. And so many times we hear you talk about taxation, but that's kind of the end of it. So this gives you an opportunity to use a method that we've seen over the last 20 plus years that's just really, really simple, something that they can actually put in their pocket or their purse, take home, and actually know that they've done some good planning with you there at the table. So if you're focusing just on growth, I really do believe that you're missing half of the opportunity to serve there. The other half is really protecting that growth from tax degradation. So like Greg said, I'll give you an overview, and then my friend Bill will give you some additional context to use. By the way, just hone in on these, and these tools will actually help you build your book of business better. If you have any questions, obviously Bill and I will be available after this call to handle anything that you have there. As you look towards using this tool, it is a T chart, so I encourage you to visually draw a T. We're going to talk about the flow of where these areas of taxation occur, and the first one is taxable. These, as you know, there's really about 3 quadrants of savings that you can talk to with your clients. And our goal here today is really just to identify where those clients' assets are currently. That's something that you do in day out, and really how it affects their retirement and their income as they age. So the first one, as you know all of these products, all of these solutions: CDs, stocks, corporate bonds, savings accounts. These can be taxed as obviously capital gains or as part of ordinary income. But if you don't know, the current highest capital gains tax rate is not just 20%. It's actually 20% for the top long-term capital gains rate, plus an additional 3.8% on investment income. I know you know that if you're watching this, but if you don't, 23.8 is that top capital gains rate. So the question there is, what percentage, Mr. and Miss Clients, of your assets do you have in this taxable box here? Then we go to tax deferred. Obviously, there are several things that can grow tax deferred. You've got traditional IRAs, you've got your 401k, 403b, 457, annuities and pensions. But you also need to be aware that these are taxed as income as well at ordinary rates, which can be as high as 37%. So the question there is very simply, what, Mr. and Miss Client, do you have in this box? And so you're formulating a kind of a percentage. You've got a percentage in your taxable quadrant, you've got a percentage in your tax deferred quadrant. And of course, the last one that we're going to talk about is tax free. And as far as I know, there's really only 3 areas that you can put money in that is tax free. and this is above the red line. You'll notice visually that that line is red or orange. I'm not sure what color that is, but it gives you the ability to visually make a delineation between the taxable, the tax deferred, and now the tax free. So now we've got the municipal bonds, which, as you and I both know, really aren't keeping pace with inflation, but could be an option down the road. We've got the Roth IRA, which I love, great vehicle, but you do need to be aware of its limitations. If you make too much, obviously you can't use it. You're restricted on how much you can put in. You may be penalized, obviously, if you take out distributions before 59 and a half. And most importantly, where are most of these funds invested? They're invested in the market. So there's potential volatility there. Not to beat up the market too much. We've all made some good money in the market, but that is a risk. And as you have clients that are worried about aging and what their money is actually doing, then you do want to make sure you have that discussion about volatility. What I want to bring to you today is 7702 planning. 7702 planning is really important to us in the industry. And we find as books of business continue to age, the more advantageous it is to use some of these products there. So this plan specifically does not restrict income limitations. It does not limit you on how much you want to put in. It does not penalize you if you want to use it before 59 and a half. We love that. And it can give you also principal protection. We call it buying dollars for pennies, if you will. It's really everything that a Roth is not. So if you are aware of the major tax codes, then you know 7702 as well as you do 401k, 403b, 457. If not, would love to talk to you about 7702 and make sure that you understand how to think proactively about your clients' futures in these categories. So the bottom line here is, what percentage of your clients' assets are in tax-free vehicles? That's a fantastic question to ask. And many times you'll find that very little or even zero are in some of these other tax-free vehicles. So this, of course, helps you reposition some of those assets as you have those very important conversations with your clients. So I hope this visual has been a help to you. I can give this to you after the call if you'd like to see it again. But let's get started with some more context, Bill. Tell us about the details here within this plan.